Hey, it's Lewis here and welcome back to the channel, and in today's video I'm going to be analysing Adobe stock. I'm going to be using the TIKR terminal to go through the financials, and then I'll be putting the numbers into my analysis checklist to ultimately see if the business is of good enough quality for me to be interested in. And then after that I'll be putting the free cash flow into my DCF and we'll come to a fair value of their stock. Let's get straight into it. Who are Adobe? So Adobe Inc. is an American multinational computer software company and it's headquartered in California. The company itself specialises in software for creation and publication of content, graphics, photography, illustration, animation, the lot. They do absolutely all sorts of stuff. The main products you probably know are Photoshop, which is an imaging editing software, Adobe Illustrator, so visual effects and stuff, Adobe Acrobat Reader, and the portable document format PDF. So Adobe essentially made PDF. That's one of the most widely used things on PCs, Macs, anything. PDFs are everywhere. So yeah, they do everything to do with software. They've got a big portfolio of different business software, and yeah, their customers use it all essentially on a subscription basis. The company was founded in 1982 by a couple of blokes, and yeah, so. The company is a big company, 26,000 employees worldwide, and yeah, apart from that, S&P 500 component, S&P 100 component, so not only on the biggest 500 companies and the biggest 100 companies, and we're also part of the NASDAQ 100 as well. Now let's have a look at the sales for Adobe, and we'll start with the sales per business. And the digital media section makes up 73%, digital experience makes up 26%, and then a sliver, 3%, is made up of publishing and advertising. Sales per region, so half the sales come from the US, EMEA, I'm guessing that means Europe and some other regions, 27%, APAC, Asia Pacific, and something else, I'm guessing 16%, other Americas 6%, so basically half the revenue comes to the US, half of it comes from worldwide, so a decent mix there in terms of where the revenue comes from. Now let's have a look at the Adobe financials using TIKR terminal, and as always let's start with the income statement. So yeah, 2016 to 2021, Adobe's revenue has gone up absolutely massively. Growth rates of over 20% a year, apart from 2020, COVID. You'll see that a lot with a lot of the companies that analyse. 2020 was a bit of a write-off in terms of, getting better growth. Anyway, off topic. High growth company, 20% revenue year on year. They've tripled the revenue over the past, 5-6 years, whatever. Solid. Gross margins as well. You can see that the gross margin is actually increasing over time as well. Amazing stuff. Then yeah, net income. So yeah, this has been growing as well. What's interesting about Adobe is, even though the revenue has trebled, just about, their profits have quadrupled. This is epic. Really, really good stuff. Yeah, let's have a look at the shares outstanding. So this ever so slightly decreased, not by much. We've not bought that many shares. I'm guessing used for capital in the business to grow the business, which is totally fine. Maybe when the company gets more mature and a better valuation, buy back more shares. Yeah, so buying back shares isn't a priority for Adobe right now, which is totally fair enough. They don't have to do it. Yeah, so what else have we been up to? Balance sheet wise, cash on hand has been going up. Lovely metric I like to see, just something simple, What else we'll look at? Long-term debt. So the company itself has taken a little bit of debt over the past couple of years. Not a big deal if the company can pay it off rather quickly, but yeah, you wouldn't want it to increase by much more, or you want it to have a very good reason why we're taking on a big lump of debt. Right, okay, so retained earnings jumped massively over the past 5 or 6 years. Lovely stuff. What else we're looking at? That's it for that one. So cash flow statement. Cash flow from operations minus capex is free cash flow. So you can see that the cash from operations has been going up massively, but the capex has stayed quite small. So the free cash flow is going up massively. Basically, this is a cash generating machine of a business. Great stuff. No dividends, the use of capital to grow the business, and not a little bit of share repurchase, but not much. But yeah, it's not that much in the grand scheme of things. Hopefully if you haven't been buying back shares when the company's being expensive, but that's something you'd have to do your own research on, because buying back shares at expensive prices is never a good move. Right, okay, onto the ratios. My favourite bit of the financial statement analysis. This section tells me the story of a business a bit better than just what plain numbers can do. Yeah, you can tell that revenue's going up, profits going up, great, but these ratios give you a real insight in the story of how good a quality business is, in my view. Return on capital, it's been going up over time, and it's now at nearly 30%. It's at 30%. Epic stuff. That is extremely high, and I like to see 15%, so it's double at the minute. Gross profit margin we spoke about earlier, going up slightly as well. 88% margins, gross profit margins, extremely high is that. Net income margins as well, absolutely solid. 31% for 2021, very highly profitable business, and free cash flow is even higher, so that's an ultimate win-win. Current ratio, lots of liquidity, no problems there. What else? So debt to capital, in the grand scheme of things, that debt we've taken on means F all. 24% debt to capital, there's not much debt in the business, let's be honest, and you could probably pay it all off with 1 year's free cash flow, so that's solid. So yeah, overall, high quality business here. If you want to use TIKR yourself, link in the description below. You can join TIKR and have some good fun looking at the financials of companies. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions, you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. Now let's have a look at the genuine impact stats for Adobe, and we'll start with the quality metrics. So yeah, it's looking interesting here with very high, so it's 936 on the ranking system, so profitability very high, financial strength strong, capital allocation medium, so yeah, it's in the top quality companies for genuine impact, so it's clear that it's a high quality company. Look at that return on equity too, 43%, lovely stuff. Value wise, very expensive, not something we like to see on this channel. So income statement very expensive, and it's just expensive across the board. But silver lining, there's lots of growth here, so high growth everywhere. This looks like to me it's an expensive company, but it's got good quality metrics. Basically means you need to wait till it falls a bit, but these things can happen rather quickly as well. So now let's go through my analysis checklist for Adobe, and we'll start with my first pillar, so profitable, high returns on capital using low leverage. So yeah, it's pretty simple here. It's pretty simple to see that return on capital is absolutely smashing out of the park, 23%, 5-year average, lovely stuff, way above what I like to see. High quality businesses over time have high returns on capital, and Adobe is high quality, simple as that. Now onto the margins, and gross profit margin 87%, 5-year average, very, very high, probably one of the highest out there for a well-known business. Net profit margins as well, 30%, and free cash flow margins 33%. Yeah, that is just unheard of over a long period of time. Only the very best businesses can have that higher profit. Often software, but nevertheless very, very good. Current ratio 1.3, so a lot of liquidity in the business. Yeah, really good stuff. Cash conversion cycle -2. Essentially what this means is the suppliers are cash financing the business, really, because it takes the company a lot longer to pay its invoices than it does to get its sales through the door. So that is just really good. Like, only the highest quality businesses can have a minus cash conversion cycle or working capital cycle. It's a new thing I've added, but I think it's a cool metric to add in, because if you can get businesses with a minus CCC, you're absolutely laughing, let's be honest. High quality businesses only have that. Total debt to capital, 24%, very manageable amount of debt. They could probably pay it off with 1 year's free cash flow. So yeah, awesome stuff. Proven ability to grow, so yeah, we see from the financials, I don't really need to talk about it too much. They've grown across these 4 metrics very easily, simple as that. Okay, great capital allocation. So what have we been doing the cash to reward the shareholders? Because capital allocation is a massive part of where shareholder returns come from. Long-term debt repayment, they've reissued a bit of debt, but it is what it is. You know, this is probably half the free cash flow, whatever, not a big deal. Decrease in share count, with ever so slightly decrease the shares. In my view, we probably shouldn't have bought back any shares if the shares were looking expensive, but it is what it is. You can't really do too much about it. As long as we're not destroying lots of shareholder value, you can deal with it. Dividend growth, Adobe don't do dividends. They reinvest back into their business to grow it more. So you wouldn't want them to pay a dividend because we can get a high return. If their return on capital is 23%, you don't want them paying dividends. Simple as that. Good acquisitions, gain on asset sales versus asset write-downs and goodwill impairment. It's in the green, so it doesn't look like they've been writing off any goodwill, which is great. Maybe sold off a few assets here and now, whatever. So it's in the green, which is fantastic. Quality score of 87%. So what metrics are in the red? Long-term debt and dividend growth. Dividend growth's harsh because we don't pay a dividend, but it is what it is. So very solid score here. Okay, buy at a fair price. The most important thing when you're buying a company is you've got to buy at a fair price for whatever return you're wanting. And at the minute, PE ratio of 39, impressive free cash flow of 27. It's looking a bit steep for Adobe in my view. What's the share price now? $391. So DCF a 10% return, I want to buy at $270, something like that. So we've got to drop about 30% or so still. So still a long way to go before I'd be interested. But nevertheless, it can and probably will get there at some point. You know, valuations don't stay high forever. Right, onto the DCF valuation then. And yeah, so what we've got here. So free cash flow estimates, all taken from marketscreen.com. You know, 3 years analyst estimates, and then the growth rate of 2.5% until the end of time. My return rate is 10%, and adjusted for net cash, $271 per share. Like I said, it's going to drop 31%. But yeah, great quality business as we can see. This is probably a very conservative figure as well, because I've only estimated 3 years into the future and then 2.5% growth from there. You could probably argue it deserves a lot higher than that. But I keep this process the same for all companies, big, small, growing lots, growing little. I like to keep my process similar. If I could buy Adobe for $270, I think this is a great price in my view, because it's such a high quality business, simple as that. I don't really say much more. Just look at the financials yourself. Look at these figures. Yeah, this is a conservative price for Adobe, but if it gets there, I think it'll be laughing long term. So there we have it. That was my full stock analysis for Adobe. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos